Hi friends, before I talk about the strategies which I had executed yesterday, I would like to show you something which is against the fundamentals of option pricing. Have a look at the screen. As you can see at 11:41 on 31st August, 18,150 call has LTP of 0.8 and 18,400 call has LTP of 0.90 and it appears against fundamentals. The highest strike price should have lower call premium and vice versa. But you may say that one cannot conclude it based on LTP because there could be difference in timings of the trade, and you're right. But I'm going to highlight something which is really against the fundamentals of option pricing. Look at it. 18,150 call has bid price of 0.8 and offer price of 0.85 and 18,400 call has bid price of 0.85 and offer of 0.90. This is against the fundamentals of option pricing. Why is it against the fundamentals of option pricing? Have you ever heard of high risk coupled with low profit? Of course, you would call it foolish. And if I say lower risks coupled with higher profits, we will doubt it. You will experience both statements in the given situation. Buyer at 18,400 call is ready to pay more premium than the buyer at 18,150 call. Hence, the buyer at 18,400 call is paying higher premium for lower profits. Means high risk and low profit, and vice versa for buyer at 18,150 call. That is low risk and high profit. In the same manner, the seller at 18,150 call is selling the call at lesser price than the seller at 18,400 call. Hence, the seller at 18,150 call is ready to receive less premium against high risk. That is high risk and low profit, and vice versa for 18,400 call. That is low risk with high premium means high profit. So was the case even with 18,200 and 18,300 strike prices. But for better understanding, I have not pasted the order book of those strike prices. In financial market, anything against fundamentals leads to bumper profit. How can you gain profit in such situations? In such cases, first, you can enjoy arbitrage opportunities, but many times such a minute difference may not cover the cost associated with it. Second, you can have zero cost bull call spread or something unbelievable. That is, bull call spread coupled with receipt of premium on the day of execution. In the same manner, if such scenario does exist in the case of put options, you can have zero cost bear put spread or something unbelievable. That is, bear put spread with premium receipt on the day of execution. We use such irrationality in premium pricing while drafting so-called minimal risk or almost zero risk strategies in Nifty and Bank Nifty. Yesterday, I found similar pricing in case of 32,600 and 32,500 put of Bank Nifty. 32,600 put not only had a less LTP but also lower bid and offer prices than 32,500 put. But while recording the video, the bid and offer prices corrected. While watching the video, you will understand it. Hi friends, so today I'm going to execute some orders. So I'm going to play short ratio put spread strategy in Bank Nifty. First of all, I would like you to show something against fundamental. As you can see it on the screen, 32,600 is trading at 3.80, whereas 32,500 is trading at 3.85. Isn't this funny? So now I'll execute the orders. So I'm going to buy Bank Nifty 5 lot. The order is executed. And now I'm going to sell 31,500 put 10 lot. This order has been executed. Hello friends, so today I'm going to execute some orders. Please have a look at them. So here in this strategy, I am buying 40,000 call expiring on 9 September 2021, and I'm selling here 40,800 call expiring at 9 September 2021. So we want to execute ratio call spread in the ratio of 1:2. We have bought 5 lots of 40,000 call. We have to sell 10 lots of 40,800 call. But due to bid spread, I have sold 5 lots. Now I am going to sell next 5 lots. So I'll tell you the logic afterwards. Hi friends, so as you know, today we have executed short ratio put spread and short ratio call spread strategy. So on the screen you find the net position. So here I have bought 40,000 call 125 quantity, and here I have sold 250 quantity of 40,800 call, and in this one I have bought 32,600 put 125 quantity and 31,500 put 250 quantity. So friends, in addition to this, I've executed short ratio put spread strategy in Nifty. So here I have bought 15,800 put 250 quantity and I have sold 14,550 put 500 quantity. For the sake of understanding, here I have mentioned it as 1 and 2. I bought 15,800 put at 1.3 and I have sold 14,550 put at 1. I have executed this strategy in Upstocks, but the Screencast-O-Matic was not compatible with it, so I couldn't record it. On day 1, friends, we have bought 32,600 put, quantity 125 at price 4.1, and here we have sold 31,500 put, 250 quantity at 3.2. For the sake of simplicity, I have mentioned here as 1 and 2. So the cash flow is, here it will be minus 4.1 because we have paid the premium to the seller, and here we got 6.4 because we have received the premium 3.2 into 2, which is 6.4. So on day 1 the cash flow is 2.3. On expiry, if the market is 33,500, from this position 32,600 put buy, we are not going to receive anything because the market is not below 32,600, and from this position 31,500 put sell, we are not going to pay anything to the buyer because the market is not below 31,500. So on expiry we are not going to receive anything, or we are not going to pay anything, so 0. But on day 1 we have received 2.3 and the net payoff is 2.3. So is the case with 33,000 and 32,600. But friends, if the market is 32,500 on the day of expiry, from this position 32,600 put buy, we are going to receive, because the market is below 32,600, we are going to receive 100 rupees. And from this position 31,500 put sell, we are not going to pay anything because the market is not below 31,500. So on expiry, if the market is 32,500, we will receive 100 rupees. On day 1, we have received 2.3 as cash flow. So the net payoff is 100 plus 2.3, which is 102.3. And friends, the market is 31,500 on the day of expiry. From this position 32,600 put buy, we are going to receive the money from the seller because the market is below 32,600. So if the market is 31,500 on the day of expiry, we are going to receive 1,100 rupees. But if from this position 31,500 put sell, we are not going to pay anything to the buyer because the market is not below 31,500. So on expiry, we are going to receive 1,100. And on day 1, the cash flow which we have received 2.3. So the net payoff is 1,102.3. And if the market is 31,499 on the day of expiry, from this position 32,600 put buy, we are going to receive 1,101 because the market is below 32,600. And from this position 31,500 put sell, we are going to lose 2 rupees because we have sold 2 quantity. I mean double the quantity. The market is less than 1. So 1,101 minus 2, which is 1,099. And on the day 1, the cash flow which we have received 2.3. So 1,099 plus 2.3, which is 1,101.3. So the logic behind this is really simple. If the market goes below 31,500 by rupee 1, from this position 32,600 we are going to receive rupee 1, but from 31,500 we are going to lose 2 rupees. We have sold double the quantity and there will be net reduction in cash flow of rupees 1, because from this position we are receiving rupee 1 and from this position we are losing 2 rupees. So here you can see the change. Here it was 1102.3, but now here, because the market has reduced from 31,500 to rupee 1, which is 31,499, so the net payoff is 1101.3. Hence the break-even point is 31,500 minus 1102.3. So the break-even point is 30,397.7. So the maximum profit at 31,500 is 1,102.3. Total it is 1,102.3 into 125, which is 1,37,787.5. And the maximum loss is below 30,397.7, theoretically unlimited. So the minimum profit is from 32,600 to infinity, 2.3, and 125 into 2.3, which is 287.5. So the total loss turns out to be 287.5. Though the risk is theoretically unlimited, but we are going to make it limited. We are going to make it limited once the market reaches 32,600. We are going to square off all the positions at profit. If someone is willing to keep stop loss for this strategy, they can go with 2.3 minus 4.6, which is stop loss. 4.6 is stop loss. So 2.3 minus 4.6, which is minus 2.3 into 125 the quantity, which is minus 287.5. And then the risk reward maximum loss is to minimum reward, which will be 1:1. In case of maximum loss, stop loss will have free of cost 32,600 put buy and 31,500 put sell, which will significantly bring down the maximum loss of 2.3 rupees per unit, which is total 287.5. And in the best case scenario, can offer us profit of minus 287.5 plus 1,37,787.5, which turns out to be 1,37,500 rupees. For remaining two strategies, many times I've discussed the payoff in detail. As video will get very lengthy, I am just going to show you the screen. You can go through it. In case of any doubts, you can ask me through comments. I've calculated payoff for 3 strategies on a sheet of paper, and then I've plugged in Excel. At most of the places I have not used formula. If there are any errors, please ignore them. Thank you.